QuickBooks Online 2021 Credit Memo, Refund Form, and Bad Debt Expense. Let's get into it with Intuit's QuickBooks Online 2021. Here we are in our Google search page. We're going to be searching for QuickBooks Online Test Drive. Then we're going to be selecting QuickBooks Online Test Drive Intuit. And then if Intuit tries to stop you because you're a robot, you just look Intuit in the eyes just like this and you say, yeah, I'm a robot Intuit. What are you going to do about it? And then you just kind of push your way in like this. And see, here we are. Intuit's not going to do anything. So in any case, we're now in the Craig's Design and Landscaping Services practice problem. We're going to be looking into a credit memo. Let's select the plus drop down. We've been looking into the information for the customers section over here. We're now going to be considering the credit memo, which hopefully isn't normally part of our sales cycle because it's basically going to be reversing a sales transaction. I'm going to click back off of this item. To see this, we're going to want to look at a flowchart. We're going to look at the desktop version just to see the flowchart. So you don't need the desktop version, just looking at the flowchart within it. So we saw our sales cycle here, and we're trying to think about, well, where does the credit memo fit in to the sales cycle, and what's going to be the impact of the credit memo? So notice to see that we have our couple different ways that the sales can take place. We have the full accrual type of process, doing the work before we get paid, invoice, increase in accounts receivable, recording the sale, then receiving the payment. We get paid at this point in time, accounts receivable goes down, and then we record the deposit. Or we might get the money at the same point in time that we do the work, and that, you'll recall, is the sales receipt type of form. So where does the credit memo fit? It kind of depends on what the credit memo is going to do with regards to where we are in this flowchart. So for example, if we created an invoice and we have not yet received the payment, then when we have a credit memo, if someone comes back in and let's just pretend it was an inventory related item, they return the inventory, basically reversing the sales transaction, then we're going to basically apply the credit memo here, which would basically be reducing, we would expect it to reduce the accounts receivable. We're going to reduce the accounts receivable, and we have to do something to the income statement, most likely depending on the method that we're going to use. Either record bad debt expense, reverse the sales item, sales returns and allowances, or if we're using the allowance method, we might record it to an allowance for bad debt. So we'll talk a little bit more about that as we go, but the point being here that if we put the credit memo right here, we got to reverse accounts receivable for sure. Then if we got paid, however, and we're making a credit memo, so we had an invoice and then we have the received payment, and now there's a return of the inventory or a reversal of the sales item for whatever reason. Well, now we're not going to reverse the accounts receivable, but rather we have to give a refund or provide them some type of credit for future purchases possibly. And the same would be true here, because this item up top, if we made a sales receipt, that would be kind of like the same thing as if we had the invoice and then the received payment. We already got paid for it, so if we're going to reverse it at that point in time, we're not reversing the receivable, but rather we need to issue a payment, pay back, or provide some type of credit for future purchases, meaning they can pay it towards future purchases. So that's the first thing we want to consider. Are we dealing with accounts receivable, or are we dealing with a payment that's got to be paid back? Then the second thing, if we're dealing with accounts receivable, that means we have to reduce the accounts receivable, but then we want to consider what's going to happen to the other side, because the other side of the transaction was an increase to sales. So what are we going to do for the other side of the transaction? Are we going to reduce the sales, have a negative sales transaction, which is not kind of the norm that we would do? Are we going to use like a direct write-off method for the accounts receivable and use this as our direct write-off method, in that case recording bad debt when we determine it becomes bad debt, so we can record it to bad debt? Or we could be using, say, an allowance method. So if we're using an allowance method, then possibly we write off the other side to allowance for doubtful accounts. We might reverse it instead of to sales to an account called sales returns and allowances, which is kind of a contra sales account. So we have that issue. And then we also have the issue of inventory if we're dealing with inventory. If we're receiving the inventory, is the inventory still good? Do we have to include the inventory back on the books? Or is it damaged in some way? Or do we just not include the inventory? We're not going to include or reverse the inventory process of it because the inventory is not good at that point. So those would be the things we need to consider. So let's go back on over And let's create an invoice first. I'm going to go to the new, we're going to create an invoice, and I'm going to make an invoice, and I'm going to make the invoice in 2020 and then credit memo in 2021. So I'm going to say this is going to be an invoice on, let's say customer one, and we'll tab through this, and I'm going to make it, we'll save this here, and then I'll tab through this, and then I'm going to make this as of 12/31/20, 12/31/20, and then we're going to go down. I'm going to make a new item, an inventory item, so I'm just going to call it inventory. So it's an inventory item, and we're going to add that. So we'll add an inventory item up top. So inventory, and I'm going to go down here and say that we have on hand, let's just say we got 100 of these on hand, and I'm going to go back to December and say they're on hand, you know, before that time period, let's say the 27th. And reorder point, I'm not going to put anything there. Description is just going to be inventory item. Sales price, I'm going to say is $1,000, so nice even 1,000. And it's going to be taxable. It's going to be a taxable item. And then the cost, let's say the cost is going to be 600. 600 is the cost, and that's going to go to cost of goods sold account. Let's go ahead and save it and close it. So I'm going to say save and close. When we record this, it will be an invoice. Therefore, accounts receivable is going to go up by the full amount, including the sales tax, by $1,080. The other side is going to go to sales, but only for the $1,000. Then the difference, $80, is going to be going to the sales tax payable, and then we'll have a cost of goods sold and inventory for the cost of this item, which I think I put on for 600, I believe, if I remember. Let's go ahead and save it and close it and check that out. So I'm going to say save it and close it. And then let's open up our reports. I'm going to right click on our report up top and duplicate it. So I'm going to duplicate that. And then I'm going to right click another one and duplicate another one. I'm going to duplicate it twice. And we're going to open up our two reports, one being the balance sheet. So I'm on this tab to the right. I'm going to go down to the reports. And let's open up then our balance sheet report down here. Balance sheet report. So there we have that. And then I want to make this for the prior year. So I'm going to make this 01/01/20 to 12/31/20 and run that report. So I'm in here for the prior year now. And if I take a look at this, I should have had an increase to the accounts receivable. Accounts receivable going up in December. So there's the accounts receivable. I'll close the hamburger. And there it is, 1,080. And then I'm going to go back up top and go back to our forms. The other side going to the income statement. So I'm going to run this report in the second tab. I'm going to go to reports. We're going to go to the income statement, otherwise known as the P&L, the profit and loss. Changing the dates up top to the prior year of 01/01/20 to 12/31/20. Run that report, close the hamburger, and so then we should have our income up top. Now it's going to be down here in our sales of product income, so it's going to be this item down below. So if I select that, then we have the 1,000 here. So I'm going to go back up top. The difference between those two is the sales tax payable, which is back on the balance sheet. So if we go back to the balance sheet, we've got the sales tax payable, which is going to be a liability account, and that's going to go to the Board of Equalization. So that would go there. Then we have the inventory that went down. So the inventory asset's going to go down here. And so if I select this item and scroll down, it's going to go down by that 600 that we charged it for. And then I will scroll back up. The other side of that is going to go to the balance sheet. And that's going to go into the cost of goods, the income statement. That's going to go into then the cost of goods sold. And here's the cost of goods sold. And that was for the 600. So let's just look at this invoice and let's just write that. So if we just think about the accounts affected, then, and I'm going to do this with debits and credits. If you want to think about it in plus and minus, that's fine as well. But I'm going to say the sales went up 1,000. We had sales tax that had to increase by $80. And then the receivable, then I'm going to use the negative sum is going to be the 1,080. So we have a receivable 1,080, sales went up by 1,000, and then sales tax, the payable went up by 80. And then we had the inventory, and the cost of goods sold was 600. That's what happened with the invoice. Now, the way you want to think of a credit memo is to reverse that exactly. So I wouldn't try to think about what happens to the accounts in a credit memo in and of themselves without first visualizing the invoice, then reversing it in your mind. And also, I'm not going to try to put the debits on top in the credit memo. I'm just going to think of it as the invoice, same layout, and then reverse the debits and credits. So this is the way I would think about a credit memo. The accounts receivable would then be credited. The sales tax payable would then be debited. And then the sales, and this is the funny item, sales will then basically go down, right? You got to negate the sales that happened. And then if there was inventory that was returned, you would reverse the cost of goods sold if that was applicable. So then we'd have the inventory going back up and the cost of goods sold then being reversed. Now the tricky thing in here, of course, is going to be the sales account and the accounts receivable. Meaning, if we already got the receivable, then it's not going to be accounts receivable. It's going to be a decrease to cash, or it's going to be allowing for a credit for someone to purchase something on credit in the future. So if we had already received the payment, then this top one could possibly be cash if you're giving cash back. And then the other tricky point is going to be this sales item down here, because usually we don't reverse sales directly. Normally we would want to do something else. Possibly if we're trying to record this as bad debt, we might call it bad debt expense, which would do essentially the same thing, but now we're calling it bad debt, writing off basically the accounts receivable to bad debt, and that would be writing it off at the point in time kind of we determined it to be bad, which would be like the direct write-off method. You might also say this is going to go to sales returns and allowances, and this would basically be the same thing as reversing the revenue, but we're kind of reversing it to a contra sales account, sales returns and allowances. Or if you're using the allowance method for bad debt expense, you might call this allowance for bad debt. And this one would be a little bit different because it would actually be a balance sheet account that we would have up top. So let's think about these scenarios. Let's say bad debt expense. Let's say that's what we want to do. So this would be the reversal direct, and then we might want to change it kind of like the bad debt expense. So if I go back on over and say, all right, now we're going to issue a credit memo for this. I'm going to close this back out. I'm going to then go back to the first tab. We're going to go into the new plus button. We're going to go down to the credit memo. Now, it might be useful to have the invoice open at the same time because you're going to kind of mirror the invoice when you enter the credit memo. We're going to have the customer, same customer, customer one that we're going to have here. We're going to say the credit memo happened in 2021 now, so it's in the following year. And so I'm going to go down and say that the thing that we're going to be reversing then is the invoice. This is going to be inventory, inventory item. So there's going to be that inventory, and this is going to be the reversal. Now, if I just record it like this will reverse, in essence, the invoice exactly, meaning we'll basically be at this scenario up top. So let's look at that first. So we have that issue, and we also want to be able to tie out the credit memo to the invoice, which we're not doing just when we enter the credit memo. We're going to have to do another step in order to do that. So I'm going to say save it and close it. Save it and close it. And now if I go to my reports up top, we entered this in the following year. So we entered it in the following year. And I'm going to go back up to the balance sheet then. So let's change the year. Now, note that this is kind of important because if the invoice was already in place and we finalized everything for 2020, you might say, hey, why don't I just go back in and delete the invoice? Because it's kind of like I didn't have the sale, what happened there. But you don't really want to delete something, and you certainly don't want to delete it in the prior year. Typically, what you want to do is keep the audit trail and add something else that will happen. So this way, all the prior period numbers are the same. We didn't change the prior period by deleting an invoice, for example. And then once we go to the current period, after the cutoff, the reverse is going to happen in 2021. So let's check it out. We're going to go in 2021. Let's just up the date to 01/01/21 to 12/31/21. And then I'm going to run that report. And so here's the reversal transaction. we have the income as basically negative income up top, and that's that questionable line, where we might want to change it from the negative income to sales returns and allowances, or to bad debt expense or something like that. There's the reversal to cost of goods sold, and that's going to be the income statement side of things. Let's take a look at the balance sheet side of things. If I go to the balance sheet, I'm going to change the date up top once again from 01/01/21 to 12/31/21. Run that report, and we're going to say now if I go into the accounts receivable, we've got the reversal happening in the proper date in 2021. So the reversal happens in the proper date with the credit memo here. So then if I go back over, we also see that the sales tax is going to be affected here. So if we go to the Board of Equalization, we have the sales tax that is being reversed as well. So we have the exact reversal there, and then we have the inventory that's going to be reversed as well if we're dealing with inventory. And so if I go into the inventory, and again, the inventory is now going back up, which we would only want it to do if we are receiving the inventory back and it has value to it, right? So then let's go back on over. Now, the other thing that we want to think about within this accounts receivable account, this is supported by the customer information. So if I go into this, we see here that we have the credit memo that is applied. And if I go back to the prior year for the detail, and I could see the invoice as well, I'm going to run that report for 2020 to 2021. We see down here that we have the invoice, and then these two look like they tie out, and they should tie out, and QuickBooks may tie them out when you make the credit memo, but you want to make sure that these two things are linked. So if I go back up top then, and I go back to my balance sheet, you can kind of check that by if I go back to my customer item or my first tab, go down to the sales items, go to the customer information up top, and we're looking at customer 1. And we want to make sure basically that this invoice that we created is reporting as paid. And now we didn't actually get money, it was paid basically by the credit memo here. So if I go back into this invoice, it's now being reported as paid. So we could see here, and it's the amount that's being applied. So if I select this item, then we've got basically the receive payment item that has been linked to the credit memo. Now, so if this didn't happen automatically, then you'd have to go in and do that process. In other words, if that didn't happen automatically, you'd have to go back up top, and then you'd say receive payment, as if you're getting paid, you know, you're getting a payment from the customer. And then this is the form where you could do that manual transaction. So if you entered customer 1 and it had not applied them out, then you'd see that transaction. So in other words, if I go back into that invoice and then I go into this payment item and look at that, this is what you would see, right? We have the company 1, and then they checked off the invoice as if it were being paid. And then down here, we have the applicable credit, which was generated by the credit memo, those two things canceling each other out. So if this receive payment form wasn't generated automatically, then you'd want to go through and link it together. If you didn't have a credit memo for the full amount of the invoice, it may well not have applied out automatically, or if there are multiple invoices open, it may not apply automatically. So you're going to want to go in here and make sure to do that process to link them out. So I'm going to close this back out, and then I'm going to go back up top. Now we have everything looks good, but now we have this issue where we have this negative sales, right? We've got this negative sales item. Possibly we want to put that amount not into negative sales, but bad debt expense maybe, or maybe we want to put it into a sales returns and allowances type of account. So let's see if we could just adjust this credit memo. I'm going to go back into it, and I'm going to just go into that credit memo. And so this inventory item is what's going to be applying it to sales. So that's what's going to be applying it to the negative sales. So what if I create another item here for a credit memo type of item? So I'm going to say this is going to be I'm just going to call this credit memo item. And so then I'm just going to copy that. We're going to set this up. I'm going to say tab, and it's going to be non-inventory or service item. So I'm going to make it a service item here. And then I'm just going to copy the name, and I'm going to put it into the description. And the other side is going to income at this point. Now that's what I want to change. We don't want it to be going to income. I want it to be going to what I'm going to call bad debt expense. Now, I don't think I have a bad debt expense set up, so I'm going to set up another account called bad debt expense. It's going to be an expense type of account. So we'll set up another account. It's not going to be income, but rather an expense type of account. So we're looking expense, and the detail is going to be bad debt, and I'm just going to call it bad debt for the description. That looks good. Let's save it. Let's close it. Now this is kind of unusual because we got this item going not to an income account, but an expense account because it's a credit memo item. Now this one I'm going to set it up to be a taxable item because I'm going to reverse it out for another taxable item. So I'm going to say it is going to be taxable at the standard rate. You might want 2 credit memos, one for taxable items, one for non-taxable items. And then I'm going to say save it and close it. And so then I'm going to put my amount here at the 1,000. So I'm going to put the amount at the 1,000, and the one up top, I'm going to remove. I'm just going to make this one 0 up top. And so what that does is it gives us our same total down here. We're still calculating the sales tax. We're still at the 1,080. And the reason I'm not completing the first line entirely is because this will still reverse the cost of goods sold and the inventory. So in other words, what's this going to do when we record it? It's going to reverse the accounts receivable. Accounts receivable is going to go down. The other side, and that's for the full amount, the 1,080 plus the reversal of the sales tax. The other side would be going to the revenue item, making a negative revenue. But instead of making negative revenue, it's now going to be making a bad debt driven by this item. And then the difference, of course, is going to be reversing to the sales tax. And then we still have the reversal of cost of goods sold and inventory, and that's being driven by this item. So the fact that this item's on the books, even though it's at 0, is the thing that's going to be driving the reversal of inventory. So if we're receiving the inventory back, then it's going to be increasing inventory and reducing cost of goods sold. That's why that one's still there. So then if I save and close it, your transactions are being edited to others, are linked. Do you want to? I'm going to say yes. And so there we have it. And so then I'm going to go back up top. So if we go back up top, now we still have the cost of goods sold there, but it's not in the sales item. We moved it down here to the bad debt item. So we moved it down to the bad debt item. Now we could do the same thing if we wanted to set one up to be going to sales returns and allowances, which is another common area. So if we did that, let's just check that out. Let's change this one again. And I could just change this and say, all right, well, what if I wanted to make it not go there, but I want to make it go to credit memo sales returns and allowances account, which would be a contra income account, right? So I'm going to say, all right, this is going to be a service item, sales returns and allowances. Here, I'm just going to then change the service item to another service item, another income account. And so we could still keep it as income or other income. We might put it into other income. I'll just keep it basically as an income account, but I'm going to label it sales returns and allowances. And we can't really put it into other income because if we did, it would be at the bottom of the income statement. So then we have discounts, refunds given here. So that looks good. We can keep it at that, but I'm going to call it sales returns and allowances. This is like a contra revenue account. So it's going to be in the revenue section, but it's not decreasing revenue directly. It's decreasing another account, which is kind of like a contra revenue account. So we have the same thing. And once again, I'm going to put this in for $1,000. So same kind of process. So same thing, but then I'm going to say save it and close it. Save it and close it. And now if I go back to the report, back to our summary report, we have it now in a contra account. So it's still up in the sales items, but we're telling it, hey, look, we don't like to reverse sales directly. We got another account we're reversing sales returns and allowances. So that's another method that could be used. Now you also might be writing it off if you're using a allowance method to a balance sheet account called allowance for doubtful accounts because you're estimating, how much you're going to be writing off. So we'll take a look at that in a second, possibly, if we have time. But then this inventory is the other one. Do you want to be reversing the inventory? Maybe you're not getting the inventory back And you don't want this second half to be recorded. You don't want this reversal of the inventory and then an increase of the inventory because you're not getting the inventory. You're just reversing the sales side because we're just not going to get paid or something like that. So then if I don't want that second half, then of course I can go back in this, and all I need to do is reverse this inventory item that's at 0. That's what's reversing the inventory and the cost of goods sold. So I can do the same process, but now just reverse that. I'm just going to delete that one, and then I'm going to save it and close it. And there we have it. If we go back on over, then we have the same situation, but now it's not reversing cost of goods sold, and on the balance sheet, it would not be adding inventory back into inventory at that point, because we're just going to say, hey, we're not getting it when the inventory's gone. We're not getting it back. I'm not going to record the inventory back. Now, the last method you might have, if you know the allowance for doubtful accounts, like you might have accounts receivable and then another account that you're estimating what accounts will be uncollectible with an allowance for doubtful accounts underneath it at that time. So you could use this method then to reverse the allowance for doubtful accounts, because when it becomes bad debt, then you would take it to the allowance account. So you could do the same thing here that we saw before. I can go back in and say, okay, I'm going to make another one. And this time it's going to be credit memo for the allowance for bad debt. And so I'm going to say tab, and we'll set that one up as a service item 2. It's going to be the allowance. I'll put that here, and then I'm just going to change this income line item this time to an other asset line item. So an other asset, and then it's going to be it's going to be other current assets, not other assets, other current assets, and then allowance for bad debt. That's the one we want right there. So I'm going to say save it and close it, and then we'll do the same process, save and close, and then I'm just going to type in that 1,000. So 1,000, same look down here, but now this other credit memo is going to be driving it to the balance sheet account as opposed to an income statement account. So I'm going to say save it and close it. And so there we have it. If I go back up top, then we go back up top, we don't have any impact on the income statement. No sales, no bad debt. And then on the balance sheet, we've got then the allowance account. If I refresh the screen, I have an unrefreshed screen. I only work with fresh screens here, that's why. So then we have the accounts receivable and then this allowance account down below. And that would make sense if you've used the allowance method before. There's an estimate that would be involved in it and whatnot. So the credit memo can be kind of versatile and used in different ways to fit in however you're writing off the bad debt or making the refund, and the inventory, of course, complicates things with it a bit as well.